Ever wondered how the Oracle of Omaha, Warren Buffett, became one of the world's most successful investors? We're about to delve into the mind of this investment titan. Buffett's journey from a paper boy to a billionaire investor is as fascinating as it is instructive. Smart investing, it seems, is more than just about making money, it's about creating a robust financial future. Stay tuned as we dive into 10 of Warren Buffett's most valuable investing tips. First and foremost, Buffett advises everyone to invest in themselves. So what does investing in oneself mean? It's all about personal development and growth. It's about enhancing your skills, learning new ones, and expanding your knowledge base. Think of it this way: you are your most valuable asset. The more you invest in improving yourself, the higher your returns will be in the long run. This might mean going back to school, taking up a course, or simply reading a book that can boost your expertise in a certain field. This concept of self-investment isn't just about financial gain. It's also about personal satisfaction and fulfillment. When you invest in yourself, you're not just building a brighter financial future, you're also creating a richer, more meaningful life. You see, the wisdom of Warren Buffett extends beyond the stock market. It delves into the realm of personal growth and achievement. Remember, the best investment you can make is in yourself. Buffett's second tip is to always create a margin of safety. Now, you may wonder, what is a margin of safety in investment? It's quite simple, really. It's the difference between the intrinsic value of a company and its market price. This margin acts as a safeguard against errors in judgment or unforeseen market fluctuations. Imagine it as an invisible financial buffer that shields you from potential losses. The larger the margin, the greater the safety net. It's like buying an umbrella before it rains. You're preparing for potential storms in the financial forecast. So, how do you establish the safety net? Start by thorough research. Dive into the company's financial health, its competitive position, and future prospects. Don't be swayed by temporary market trends. Instead, focus on long-term value. Remember, the goal is not to buy at the lowest price, but to buy value at a good price. A margin of safety acts as your financial cushion, protecting you from market volatility. Thirdly, Buffett emphasizes the need to invest for the long term. You see, investments aren't a get-rich-quick scheme. They're a long-term strategy, a marathon, not a sprint. The real beauty of investing lies in the power of compound interest. It's the snowball effect of your money. Your earnings generate even more earnings, and over time, this growth can be extraordinary. This long-term perspective aligns perfectly with Buffett's own investing strategy. The Oracle of Omaha, as he's often called, advocates for buying and holding quality stocks. He's not interested in the daily fluctuations of the stock market. Instead, he focuses on the underlying value of a company and its potential for growth in the future. So, what's the takeaway here? Don't let short-term market volatility scare you away. Invest in valuable, high-quality companies and let time do its magic. Remember, Rome wasn't built in a day. Patience is key in investing. Think long-term and reap the rewards. Buffett's next two tips go hand in hand. Understand your investments and be fearful when others are greedy. Now, understanding your investments might seem like a no-brainer, but you'd be surprised how many people jump into investments without truly grasping what they're getting into. Imagine, if you will, walking into a dark room filled with obstacles. That's what investing without understanding is like. You're bound to stumble, fall, and possibly get hurt. But if you take the time to understand the company, its business model, its financials, and the industry it operates in, you're essentially turning on the lights in that room. The obstacles are still there, but now you can see them and navigate around them. The same principle applies to investing. If you understand the companies you're investing in, you can make more informed decisions, whether you're buying, holding, or selling. You're not just following the crowd or going by hearsay. You're making decisions based on knowledge, which is always a stronger foundation. This brings us to Buffett's next tip. Be fearful when others are greedy. It's a classic saying in the investing world, and it's one that's grounded in wisdom. When everyone's buying, prices go up, and the value you get for your money goes down. But when everyone's selling, prices go down, and the value goes up. So when others are greedy, it's a sign that the market might be overpriced, and it might be a good time to hold off on buying or even sell. Conversely, when others are fearful and selling, it might be a great time to buy. Of course, this doesn't mean you should always do the opposite of what everyone else is doing. It simply means that you should be aware of market sentiment and use it to inform your decisions, along with your understanding of your investments. Understanding your investments, combined with a contrarian mindset, can lead to successful investing. Now let's quickly recap the final tips from Warren Buffett. Tip number 6 emphasizes the importance of a good investing habit. Like any other discipline, investing requires consistency and discipline. Building a regular habit of investing, no matter how small, can compound over time and result in substantial wealth. Remember, it's not about timing the market, it's about time in the market. Moving on to tip number 7, Buffett advises us to stay away from debt. While leverage can amplify returns, it can also magnify losses. Therefore, it's wise to avoid borrowing money to invest. Instead, focus on saving and investing your own money. This way, you're only risking what you can afford to lose. Next, tip number 8 underlines the benefit of buying quality stocks. Buffett is a firm believer in the saying, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." So rather than hunting for bargains, focus on investing in companies with strong fundamentals, excellent management, and a track record of profitability. Tip number 9 highlights the significance of reading financial reports. Knowledge is power in the world of investing. By understanding a company's financials, you can make informed decisions and avoid costly mistakes. So, make it a habit to read annual reports, quarterly earnings, and any other financial documents related to your investments. Finally, tip number 10 talks about the value of having a sound investment philosophy. Buffett encourages investors to follow a well-defined strategy and stick to it, regardless of market fluctuations. This will help you stay focused on your long-term goals and avoid being swayed by short-term market noise. These tips, from one of the greatest investors of our time, can significantly improve your investing game. Remember, investing is a marathon, not a sprint. So, there you have it, 10 investing tips, straight from Warren Buffett. These pearls of wisdom are not just tips, but pillars for smart investing. They emphasize the importance of understanding your investments, maintaining a safety margin, and being patient for long-term gains. Remember, it's not just about being greedy when others are fearful, it's about investing wisely and for the long haul. And the best investment, as Buffett says, is in yourself. Don't forget to subscribe to Choose to Build Your Future for more investing insights and tips.